Good morning and welcome to this Monday, December 7th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we are getting, well into December now. Got second week of December coming up. Don't have to worry about those options expiring for another week. Well, 2 weeks, a week from this Friday. But a lot of these stocks that are starting to run pretty good in terms of the pandemic, a lot of the companies that struggled during the pandemic that have really caught fire as we've seen rotation take place over the past few weeks. Some of these companies may have some issues when it comes time to options expirations. That's something just keep on your radar if you're trading any of those companies. I believe as we get into next week and certainly toward the end of next week, and into that beginning part of the following week, I would expect some of these companies, if they haven't pulled back by then, could be at considerable risk. But we'll get into all that. I mean, we got time. I don't usually look at options expiration until the week of options expiration. I don't start looking at it now and saying, wow, these companies should come down. I'm going to start shorting. I think that's a big mistake because I don't think the market makers, there's really no need to even worry about it at this point. It's really about, seeing where your position is, I guess, with a few days to go before options expiration and going from there. Futures this morning, a little mixed. We got the Dow Jones down about 70 points, S&P's down 9, NASDAQ those up 7. So we got a little bit of bifurcated action, I guess, in the pre-market. Gold relatively flat. The bonds, 10-year Treasury yields down a few basis points. We finished at 0.97% on Friday, so getting very close to 1% level. We haven't seen that in quite a while. So, and that, as we move higher in the yield, as I talk a lot about, and I'll talk about again in just a couple minutes, but when that yield's rising, money's rotating out of Treasuries. There's nothing else happening. I mean, that's not a question. Yields and Treasury prices always move inversely to one another. So we got that going on. Overnight in Asia, we saw the market there down a little bit. Hang Seng was down over 1%. In Europe this morning, we got the DAX down about 0.4%. The FTSE was up a little bit. So I don't know, we're seeing some mixed action, but make no mistake, global markets have been very strong. And I do believe that we're going to continue to see very strong action in global markets, not just this year, rest of this year, but throughout 2021 as well. So I wouldn't be surprised at all to see this rally continue. The question for me is just what leads. And that's always the question for me. I want to stick with leading stocks and leading groups. Got some interesting charts for you on the growth versus value that we always look at, IWF versus IWD. So anyhow, we're going to get into all that. But let me first take you over to Earnings Beats, our site. If you're new to Earnings Beats, we've got a free newsletter. I'd love to have you join. We've got a great growing community. Thousands of folks in our community now. It's grown considerably since I came back to Earnings Beats. I guess I was back in September of 2019. Wow. Hard to keep track of the years. This one doesn't even seem like a real year. I don't know what to call 2020. But when I start thinking back, like it's been a year, it's almost like we've missed a year or something. Maybe you can relate to that. Anyhow, we do have a free Earnings Beats Digest newsletter. All you need is your name, email address. Hit that subscribe button. No credit card required. You can unsubscribe at any time. But it is a great way to get to know us, some of the things that we look at in the market. We talk a lot about relative strength, talk a lot about earnings. I would say those are the two predominant themes. But sometimes we'll look at major industry groups, something that's breaking out or something that's starting to show relative strength. So it's not always about individual stocks, although I would say the primary focus is individual stocks. But you can check that out. We'd love to have you come on board. We have a 30-day trial, $7 to get started, but then we'll refund you the $7. So you don't actually pay anything. It's a net zero over the first 30 days. So check us out now. You'll be able to follow us right in through the end of the year into the early part of 2021 at no cost. You can check out our portfolio results. There's a lot when you think about earnings beats, when I think about earnings beats, I mean, the portfolios are nice because I can quantify something. But really, I think when I think of earnings beats, I think this big research platform. We do a lot of research behind the scenes that we literally can download, have our members download into their stock charts accounts in seconds. It's really pretty fascinating. I don't think there's anything out there like it. But anyway, you can check that out. We'd love to have you. Like I said, $7 trial, but we'll refund that to you. All right, let's move on and take a look at what happened on Friday. Dow Jones Industrial Average up 248 points, back easily above that 30,000 level. I've said before, I really think before the end of this year, I would not be surprised to see the Dow as high as 32,000. I don't know. I just think the Dow, which had, lagged for a while, I wouldn't be surprised to see a little bit more movement there. We're starting to see some of its components like Boeing really start to pick up speed and accelerate to the upside. And I think that could result in a nice year-end rally. Even though we've already had a nice rally, I believe we're going to see more. I wouldn't be surprised to see the Dow lead it, just because, again, it's been lagging. S&P 500 up 32 on Friday, up near 3,700, almost got our first 3,700 close ever. I expect maybe we'll top 3,700 at some point today, if not today, this week. But we do look like we're going to start off in negative territory. NASDAQ up 87 on Friday, 12,464, continuing to pull away from its 20-day moving average, looking strong. Mid caps up almost 2%, small caps up another 2.5%. Small caps have really taken off, performing extremely well. That's one of the things I really like about the market. Anytime small caps are outperforming, it's a good thing because small caps are more aggressive. So when traders are willing to commit more to small caps than they are to large caps, they're willing to take that additional risk. And normally that's associated with a strong bull market. So I find that to be very bullish there. I like what's going on in the small caps. Energy up 5.45%. It's been quite a run. I'm not completely sold on energy. I'm more sold on energy on this advance than I was on gold back a few months ago. If you remember, I talked about gold, said, listen, if you want to play gold in the short term, feel free. But if it starts to break down, get out. And the main reason for that thinking was that gold doesn't do well when the stock market does well. When the volatility starts to come down, the fear dissipates out of the market, gold tends to underperform. Even if it's going higher, it tends to underperform the S&P 500. I don't want money underperforming. I want to try to find areas where I can outperform. So that's why I wasn't a big fan of gold. It's what based on all the signals the market's telling me, I believed we were in a secular bull market. We were going to continue to be in a secular bull market. And that means eventually that VIX is coming down, and it's been coming down. And when that happens, the fear's coming out of the market and gold doesn't perform as well. So that's why I thought gold was more of a short-term play. Energy, on the other hand, I do like it long-term because I think as we come out of this global markets rally, the global economy, I think there is so much pent-up demand everywhere around the world. A lot of, I think folks are looking at 2020 and saying, wow, what a great year, coming out of this pandemic and all. I think 2021 is going to be stronger. I mean, I'm not saying that we're going to go up 70% in 8 months like we have over the last 8 months or whatever the percentage is. But remember, we were coming off of it. You got to keep everything in perspective. We were coming off of a 35% decline in the S&P in 1 month. So yeah, we've been up a huge percentage, but if you look relative to pre-pandemic levels, we're not up that much. And that's what I'm talking about. I think next year could be better than that. So we'll see. But if the global economies are strong, pent-up demand, we start seeing more travel, things like that. Of course, energy prices could go higher and energy itself could go higher. But again, I'm going to get back to my question. Will energy outperform the S&P 500? In the short term, clearly it is, but I'm talking about 2021. Will we outperform? I don't think we will. I could be wrong. I think it's going to depend a lot on the dollar. I think, and I'm thinking the dollar goes back to the upside, but there's a lot to talk about there. Materials up 2% on Friday, strong day there. Utilities down 1%. So utilities were the worst performing group. You can see we actually had a negative divergence. I talked about this when utilities were going higher. So I was looking for a centerline test and a 50-day test. We've gotten that and some. I would look for utilities, though, to bounce here sooner rather than later. As far as our industry groups on Friday, the exploration and production index had a huge day, up more than 7%, big rally, taking out that prior high from back in November. That was a good thing. This is a group, we're trending above the 20-day. I'll just say this, as long as we are trending up, you can trade. I mean, I'm a momentum trader, so I'm fine with short-term trading of areas that are moving to the upside. I would just think long-term, just be a little bit more careful, I think, if this group or if this area of energy starts to break down a little bit. The water index was the worst performer, worst industry group on Friday, down almost 2%. But you can see also coming down, testing that 50-day moving average, very similar to what the utilities are doing. You can see utilities for the last 30 days have been down, and water also down. And that actually brings me to another point too, is defensive groups are not performing well during this rally. And that's another very bullish sign. When we're rallying like we've been rallying, we want to see those 5 aggressive groups lead. And it doesn't have to be all 5. You know, technology's kind of backed off a little bit. Consumer discretionary, certain areas have backed off some, but communication services are doing well, and industrials and financials have come roaring back. So it's almost like we've seen a little bit of passing the baton in terms of the aggressive groups. Not that anything there is performing poorly. It's just leadership is rotating a little bit more toward industrials and financials. And I think industrials are going to have a big 2021. All right, let's keep moving on. We've got the 10-year Treasury yield here. Let me give you an update, see where we are. Okay, so we are down about 3 basis points, 0.94. We closed at 0.97%. And if we pull up the little Mr. Inspector here, you can see that back in November, our high was 0.972 on the close, and our close yesterday was 0.969. So we did not take out that November high just yet. I think it's coming, but you know, after a rally, putting in this little bit of a cup, wouldn't be surprised to see a little handle go down to about 0.9%. But I do think we've got 1% coming. And you know, for those who might say, well, isn't, you know, higher interest rates, isn't that bad for stocks? Well, if you get to a certain level, yes. I mean, we're still down near historic lows. Moving from historic lows to almost historic lows is not really a big deal in terms of raising rates. I don't think the Fed's going to be acting anytime soon. If you listen to what they're saying, they're talking about maybe 2 or 3 years before they think about raising rates. They've even come out and said, even if inflation picks up, we're going to let that go for a while. So, you know, if they're truly being transparent, we should not be looking for them to raise rates anytime soon. So we might see a little bit of movement here to the upside, but this is not, you know, the Fed realizes, and they've talked about a lot, the uncertainties as a result of this pandemic. They don't know what's going to happen over the next few months as the coronavirus cases continue to surge. And then what things are going to look like on the other side of it. You know, what's travel going to look like? How many people are going to take the vaccine? Are we going to, you know, get to that point where there is herd immunity? Are we going to see the cases drop to 0 or near 0? I mean, there's still a lot of questions out there, and the Fed wants to make sure that they're there to support whatever's needed during this period of crisis. So I think 10-year Treasury yield is going to go higher. I just don't think it's going to go shooting higher. And so what that means more than anything to me is that money, lots of money is going to be rotating out of Treasuries. A lot of defensive money. When the GDP picks up like I think it's going to pick up, not too many folks are going to be holding bonds. I think that we're going to see a lot of rotation out of defensive areas and more into aggressive areas. I think small caps will continue to do very well. All right. As far as economic reports, nothing out today, very little out this week. I think I saw CPI, I think it's out on Thursday, PPI on Friday. So we got a couple inflation reports. Initial jobless claims, obviously always out on Thursday. They'll be out. And then consumer sentiment. I think there's a consumer sentiment report out on Friday. And outside of that, there might be a wholesale inventory report or something, but this is a pretty quiet week. So the market's not going to be really trading off of economic news. I think the market's going to be trading off of technicals. And so areas that have, begun to show strength, I think if they pull back, I think you'll see some technical buyers step in. I think we'll continue to see mostly boring action in the market. I don't see big drops, but I also don't see us exploding to the upside. And I'll show you that in just a second. Moving on, IWF, IWD. So let's talk a little bit about growth versus value. And anyone who's been following knows this has been a theme that I've been following for months throughout the pandemic. Even though, we had a lot of the media folks saying Great Depression 2.0 right around the corner, batten down the hatches. This is going to be awful. Stock market was sending us a completely different signal. And it was nothing like what we were hearing every morning. Because if you're heading for the Great Depression, growth stock's not really where you want to put your money. There's not a whole lot of growth that I'm aware of in a depression. So, again, this was telling us a completely different story than what we were being told every single day by the media. And, I'm not necessarily a conspiracy theorist or anything like that, but I know what media, what they're trying to do, and everybody knows it. I mean, they want you to click. It used to be that media was ABC, NBC, and CBS. I remember growing up as a kid, there were 3 channels. You had to get up, you didn't have remote control. You just get up, you change the channel. The little rotary thing, you'd have to turn around. I'm dating myself here, but, that was media back then. Today, media is 24/7. You can't get away from it. Social media. And everyone's competing against everyone for eyeballs. So the more shocking your news, the better it is because you get more people to click. So of course you're going to try and scare the heck out of everybody. I mean, to some extent, I'll be honest, I've done it not intentionally trying to scare it, but if I think that there's something to be worried about, I write about it. And the views on my articles triple if I write negative stuff. If I say, we're in trouble, the number of people that read my articles doubles or triples. Now, I don't write too many negative articles because I don't think too many negative things. I believe the market's going higher. But if your sole purpose is to see how many people you can get to click, what do you think that they're doing? I hate ranting. I know some of you get tired of me ranting, but at the same time, I think it's so important to understand that you've got to follow what the charts are telling us. That these charts, not what you're reading. But anyway, all right, IWF, IWD. So if you're wondering, okay, I want to visualize this rotation you're talking about. Well, I don't know if there's a better chart than this one right here. Growth going up, growth going sideways. This was the September high. Growth just consolidating. Was it going to break out? Was it going to break down? Well, November 9th, vaccine news came out. Guess what happened? It went down. So growth is now pulling back. Instead of moving higher and bouncing off a rising 20-day EMA, which is above the 50-day, now look, we're going down and we're hitting and we're bouncing and moving lower, below the 20-day, which is below the 50-day. Now the IWF, IWD relative PPO is in negative territory. All year, it was mostly in positive territory with just a couple of brief exceptions. So do you see, right here, this chart, says 10,000 words. I don't need anybody to tell me what the market's doing. I can look at this chart. Money is rotating out of growth and into value right now. Now, is it rotating out of all growth? Of course not. There's still leaders out there that are continuing to do well. But this is definitely a theme right now. When you look, all of a sudden, you see energy outperforming. You see, financials, industrials. Some of the groups that were underperforming throughout 2020 now are starting to outperform. So this rotation is real, but I believe the stock market's going higher and it's going to be one of these wide participation, everything goes higher deals. So the big question is what's going to lead in 2021? Not necessarily what's leading right now. No doubt value's having its day. And mostly because it was swamped throughout 2020. I mean, when you get this kind of move to the upside, you're going to eventually have more of a significant pullback. And I think that's what we're having. I don't think the long-term uptrend in this ratio is done. I really don't. Not when you're in a historically low interest rate environment and growth. There's nothing more valuable than a high growth stock in a low interest rate environment. So I think we're getting a pause. How far will this go down? I don't know. I'm going to show you a longer term chart in just a minute. But this is the daily chart for 2020 as we get ready to head into 2021. And right now, money is rotating toward value, no doubt. I'm not going to tell you otherwise because it's not true. I mean, value is definitely leading right now. Let's look at the S&P 500. I'll come back to that IWF, IWD chart in just a second. So here's a 6-month hourly chart on the S&P 500. And yes, we've been rising nicely the last few weeks. Here was the vaccine news: gap up, pullback, sideways consolidation, and then a pretty slow move to the upside. And one way you can look at that and gauge how fast we're moving to the upside, look at the PPO. PPO is a gauge of momentum. That's what the PPO does. It's looking at our 12-period EMA versus 26-period EMA, and it's showing you in terms of percentage how far the 12 days or 12 period is above the 26 period. That's all the PPO does. It's not anything fancy. It's just looking at two different periods and showing you the acceleration in momentum or deceleration. So acceleration in bullish momentum is above the center line. Acceleration in bearish momentum would be below the center line, kind of like we saw back here at the end of October. That's all the PPO does. Now, when you look at this, I look at the relative PPO, and right now it's at 0.338. And I look back over the last 6 months, this is a pretty low level of bullish momentum. I mean, we've seen many times where we've been well above 0.5. We've seen as high as 1.5. Now that's coming off the heels of a really straight up move. I mean, and take a look at this. I mean, we're talking about in a week going from 3250 to 3650, 400 points on the S&P 500 in a little over a week, maybe 10 days. And that's what gets you a PPO of 1.5 on an hourly chart. You're not going to see that very often. And I don't expect we're going to see that kind of a move to the upside. So I'm not looking for that. But this is just a nice steady, move, growth to the upside with the S&P 500. I think it looks good. Again, I think things are getting boring, a little bit more boring, and that's the hallmark of a bull market. The VIX will come down. It's going to break below 20. It's going to drift probably in 2021. It'll be drifting down much of the year. We'll have a couple scares from here, from time to time and pull back, but I believe we're going higher. I think that, my call at the beginning of the year on the S&P 500 was 40-40. I kind of used a little bit of marketing, 40-40 in 2020. But, we're at 3,700 with the pandemic under our belt. I don't know. I mean, if I had, if we didn't have the pandemic, would we be at 40-40? I don't know. That's a really good question. I don't know if we would hit it or not. Certainly, I think without the pandemic, we'd probably be higher than we are now. So I think it's reasonable to assume maybe we'd hit 4,000. But anyhow, and we still have 3 weeks. So maybe 3 weeks, a little over 3 weeks. So maybe we make a push for 4,000. I'm thinking 3,800. Maybe a little above 3,800. I wouldn't be surprised to see us finish 3,800, 3,850 at this point. But I think 4,000 is coming, and it's not that far off. All right, so let's get back to that IWF, IWD, and just want to show you a longer term chart here. So this is the long-term IWF, IWD, and down here at the bottom is a 10-year Treasury yield. So you can see, we went down below 1%, and now, interest rates are quote unquote soaring back to 0.97% as of Friday's close. Could we get back up to 1.5%, 2% in 2021 or maybe into 2022? Yeah, I think we're going to stay low, but I think, we might be a little choppy, but I think we're going to make our move back toward 1.5%, 2%. That means a lot of money rotating out of treasuries, out of defensive areas. The question is, where does it go? Does it go into growth or does it go into value? Now, when you look at this chart, this is a weekly chart. Look at the weekly PPO, relative PPO. We got to 6. Look back over this is since the beginning of 2013. This is when I identified as the beginning of the bull market, the secular bull market. It's when you clear the prior highs in 2000, 2007. It's not the 2009 bottom, because nobody in their right mind knew that we were starting a secular bull market in 2009. I mean, everybody was, the kitchen sink was being thrown in back then. Really, it's the coming back up and taking out those previous highs and breaking to a new high. That occurred in 2013 on the S&P 500. Since then, and we're almost 8 years in, you can see definitely there was a little bit of leaning toward growth. But as interest rates fell to historic levels, the money that rotated into growth was phenomenal. And so we're in this process, I think, of normalizing this ratio. Do I think we're going down to 1.3? No, I don't think we're going down that far. Why? Because I think interest rates are so low and growth is going to be so strong, in my opinion, in 2021, that growth will never make it down to 1.3 versus value. I just don't see it happening. But we do have a relative, if you will, negative divergence. That last push we had, where we tried to break out in October here, I mean, the relative PPO is going straight down. So I think this relative ratio is probably going to at least get to the 50-week and maybe even a little bit lower. I wouldn't be surprised to see us move into the 150s to around 160. I don't think it'll go much lower than that, though. I do not think we're going to just see it go down for the next year. I could be wrong. But this is what I'm going to be watching, because it's going to be really important. If you want to outperform the S&P 500, if you notice that we've reset and we start to turn back up on the WFIWD, you're going to want to make sure you're positioned in many of those growth stocks. I still think companies like Zoom are going to do extremely well. I think that there was a paradigm shift. I don't think people are all of a sudden going to turn their computer off and drive back down to the city to go to work. I just don't think that's happening. It'll happen in some instances, obviously, but I think that there are a lot of companies that realize the efficiencies, the benefits, the employee loyalty that they'll get out of folks working from home, being able to work from home. And there's going to be more applications for Zoom than just people working from home. In our business, Earnings Beats, we use Zoom all the time, and there'll be a lot more of that use going forward, I'm sure. And they'll create more opportunities. They're not just going to sit back and just do, there won't be a one-trick pony. But anyhow, enough about Zoom. But I do think growth, after we get through this period of, I don't know what the right word is. I keep thinking about like comeuppance, or I'm not sure what the right word is, but there's definitely going to be a reckoning here. And I think we're going through it right now. And beyond that, I do think that we will see more money rotating back towards growth, because that's where the valuations are going to be. That's where where you can justify higher valuations. The value stocks will have a temporary boost to the upside because they're going to start showing a lot of growth from what we had in 2020. But value stocks, their growth is going to stabilize much more so than a growth stock if our economy is strong, as I think it'll be. Anyway, long discussion there, but I wanted to go through that because I think this is a really important topic as we look out into 2021. It's something I'm going to be watching very closely. All right, moving on to earnings. The only one that came out this morning of any significance was Jinko Solar. And I saw two different reports, and I'm not sure which one to believe. On Zacks, they showed a loss of 91 cents when the market was expecting a profit of 85 cents. And I saw that and I was like, wow. And then I went to Briefing and pulled it up, and Briefing says that they beat $1.06 versus 85 cents. So I don't know which one's right. But on Briefing, they did say they lowered their revenue estimate for the next quarter. And the stock was down 6.74% pre-market. So let's take a look, see what's happening in pre-market. Well, it's come back some. So it's down 3.5% now in pre-market. But $59, it's going to be right down here in this range. Let's see what kind of reaction we get on Wall Street today. We're going to see a hollow candle where we gap down, maybe scare a few folks out, maybe a quick trip in the morning down below 55 and then come roaring back. It'll be interesting to see how Jinko is treated, not just for that company, but also for the renewables in general, because renewables have been, they've been flying to the upside, and Jinko Solar was one of those stocks leading that charge, maybe even earlier than some of the other companies with that huge run that it had back in September and October. I think it went up like 35 consecutive days or something. I mean, I've never seen a stock do that ever that I can recall. And it was just such a huge run, and we've seen renewables do great. So I'm just interested post earnings how Jinko trades today. All right, let's see. 3 you must see. Well, actually, before we do 3 you must see, here's a story that came out this morning. This is what is SLG? I can't even think of the name. I'll come back to this chart. Green Real, SL Green. There we go. I don't know why I had a mental block there for a second. Anyway, looking at the chart here, this is the seasonality chart for SLG, and I believe, pretty sure this is on our December seasonality list. But they came out this morning and they upped their share repurchase by an additional $500 million. So now they're up to $3.5 billion repurchase deal. So obviously they have a lot of confidence in their company. And just wanted to point out, December tends to be a really good month for SL Green. 70% of December's it's gone higher, and it's averaged over the last 20 years, earning almost 4% just during the month of December. So let's pull up the chart now that the market is just open, see what's going on. Well, it was actually down, or no, it's up a little bit on the news, down from the high on Friday, but up from the close. So it's up about 1.6%. But I like what's going on here. I mean, we cleared that June high. We know real estate is strong in the month of December. This is one of the stronger stocks in the space. Got the company saying we're going to buy back our shares. I suspect any kind of weakness could be bought on this stock in the near term. So SLG I thought looked interesting. But let's move on to our 3 you must see. I'm going to wrap up with 3 Dow stocks. Been talking a lot about the Dow and how I think the Dow could really roll. Some of these companies that have been beaten up that are starting to run. First, we got IBM. I mean, I still think the growth stocks in the Dow, I mean, you still got Apple and Microsoft and those types of companies in there that I think will continue to do well. But now all of a sudden, we're going to start seeing others participate, like IBM, which is now trending above its 20-day, which is above its 50-day. I think it's going to make a run probably for these highs up in the low 130s. We'll see if we can get through. But that, I wouldn't be surprised if that takes place here in the month of December. So I like IBM. Then we've got CVX, which is Chevron. CVX gapping up. Look at the gap up here. This was November 9th. It's not a coincidence. That was when Pfizer announced their vaccine news. The next week we gapped up. That's when Moderna announced their vaccine news. And so now Wall Street is beginning to look beyond the virus. Now before it was, well, we're going to try and get this virus or this vaccine, and we're going to, try to do this in record time, and we're going to do it. Now it's okay. We've got it. Now it's a matter of distributing it. And yes, the short term is going to be painful, but we've now got light at the end of the tunnel. And that is what's driving a lot of these stocks right now. So Chevron, big move up in November, pulled back, got close to 20. I wouldn't be surprised to see Chevron go up. It is having a rough day today. Watch that rising 20-day. Anything close to that, I think, would be a great entry point, because if it breaks below, get back out. And if it comes back up above the 20, you can get back in. If you're trending, you should stay above the 20-day. And occasionally you'll see a quick little move below and then bounce right back up. But that's what I'd be looking for on CVX. I would be expecting mostly bullish action here in the near term. And the last one I wanted to show you was Coca-Cola, KO. I think this one really is starting to look good in terms of some of the Dow laggards. Now, if you go down here, it's got a little work to do versus soft drinks. I would really like to see this double top right here taken out. And let's see Coke move to about a 9-month relative high to a soft drinks, because soft drinks is not a great area. So if I'm going to invest in a stock that's in an area that's not very strong, it better be a leader. And so that's why I want to see this breakout here. But there's no doubt gap up. We come back down. We basically hold gap support, hold the 20-day, and now we're trying to break out again. So I think Coke is going to break out. I think we're going to see movement to the upside. Even as we sideways consolidate, we can see the AD line already starting to make a new high. Well, it did make a new high at the end of last week. We finished last week with 2 really solid candles on increasing volume. So I think we're going to make a breakout. One more pullback could be an opportunity to get in if you like Coke. All right, that is it. Let's take a quick look, see what's going on in the market. Still bifurcated, but nothing major. We got Dow Jones down 75, S&P down 7, NASDAQ showing a little bit of leadership right now, up 26. Small caps, mid caps, both down fractionally, not really much considering what they've been doing. So I think overall we got a pretty strong start to the day here. Considering how much we've been going up, we're not really selling off much. It is a Monday. It's also starting a period where the S&P 500 historically has struggled. Once you get past the 6th of the month, today's the 7th to the 15th tends to be more bearish, especially the 11th to the 15th, 7th to the 10th, 11th. And this week is got a little, more neutral, maybe a little bit of downside, but next week, until we get through the 15th, tends to be a little bit more bearish historically. Technically, I'm very bullish. So, and technicals I'm always going to put more emphasis on technicals than seasonality. Seasonality gives you a tendency. It might say, hey, 7 out of 10 years, this happens. Well, if I'm bullish, I don't care if it's gone down 7 the last 10 years. It went up 3 of the last 10, and I'm bullish. So I'm not really going to pay as much attention to the seasonality. I might, trade fewer shares or something, because of that. But I'm not going to all of a sudden switch from bullish to bearish just because there's a tendency that the market does something. So hopefully that clears that up a little bit, because I do get that question a lot. What do you do when you say that, you're bullish and then you see that there's a stock that goes down 70% of the time? Would you buy that stock? And my answer would be, yeah, I would buy the stock. But knowing the history, that's, it's kind of like buying a stock that's breaking out. You might be looking at the PPO and it's above the center line, but it's starting to roll over. And that's what seasonality is to me. It's kind of a secondary indicator like the PPO. But nothing's more important than the actual price action. All right, let's go ahead and wrap this thing up. Hope everybody has a great day, great week. Everybody stay safe out there. We still got a few months to go here with this virus. You're seeing a lot of the cases surge around the country. So try to be smart, especially through the holidays. I know everybody's getting tired of this, wants to get together, but we really do need to still remain vigilant and, get to that light at the end of the tunnel. So I'm looking forward to a much better 2021. Anyhow, everybody have a great day and be back tomorrow over at Stock Charts for your next Trading Places Live. Happy trading, everybody.